Welcome back to Investing Talk podcast. Today, we're digging into a big question in the small cap world. Is Atlasclear Holdings a good buy right now? This is a company in that really competitive fintech infrastructure space. It's seen just massive volatility, frankly, and a lot of rapid changes lately. Before we unpack all the details from the sources we've got here, just a quick favor. Please remember to subscribe, like, and comment. And hey, if there's a specific company you want us to look into next time, definitely leave a comment below. We always appreciate hearing your suggestions. Okay, so our goal today is really simple. Give you a clear picture of Atlasclear Holdings. We've got docs on operational changes, financials, the technicals, the whole snapshot. For a company swinging this wildly, you need to know if this recent pivot signals real sustainable growth or if it's maybe just short-term hype.
Exactly. We need to cut through the noise here. Our focus is on, well, validation. They've been incredibly busy trying to trim debt while building new business lines at the same time. So the question is, do those recent big operational moves actually translate into something lasting, something stable?
Okay, let's unpack this transformation then. The sources paint a picture of the last 3 months as this really focused effort, like a surgical cleanup of the balance sheet. And at the same time, trying to fire up new revenue engines looks like a truly pivotal period.
Yeah, the main cleanup definitely hit that legacy risk. Atlasclear paid back over $21.25 million in debts. And importantly, that included those tricky DESPAC-related liabilities. For anyone unfamiliar, those are often obligations inherited from the merger that took the company public. They can be a real anchor.
A huge drag, right? Clearing that out must be massive for investor confidence.
Absolutely huge.
Okay, so the balance sheet cleanup, that's one piece. But the revenue growth side,
Yeah.
what's really interesting here is how fast they apparently scaled up a totally new business line, like that stock loan business.
Right.
It went from what, basically nothing in early 2024
Negligible, yeah.
to 15% of monthly revenue by July, and kept that pace through September.
That's incredibly rapid traction. It suggests management isn't just, fixing old problems. They're actively building new revenue streams, and potentially higher margin ones too.
And crucially, they got some serious backing. Sixth Borough Capital, they put in $500,000.
Right.
But maybe more significantly, that Haranier LLC financing. It wasn't just simplified, it was accelerated. The initial tranche jumped from $10 million to $20 million.
That is a major vote of confidence. Doubling the initial amount like that, it signals real commitment, not just a quick cash fix. Plus, Haranier got a 19.9% equity stake and 2 board seats. So they're now strategically aligned, right? It's a partnership.
Makes sense.
And they also authorized using up to $5 million of that new capital for a share buyback, which, given the tiny market cap, could be a technical boost itself.
Okay, so let's connect this operational stuff to the bottom line. Look at the Wilson-Davis unit performance you mentioned, a 260% quarter-over-quarter net income jump.
Significant, isn't it?
Yeah. And nearly $15 million in debt reduction just in September alone. You pair that with the unit income boost, and it really does point towards maybe internal efficiencies finally starting to kick in properly.
That's the hope, anyway. The numbers suggest things are moving in the right direction operationally.
Okay, we've seen the cleanup these last few months, but what's the actual core business here? Let's ground ourselves in what Atlasclear really does and maybe why they needed all that cash in the first place.
Right, so Atlasclear plays in that crowded fintech infrastructure, sandbox trading, clearing, settlement, banking solutions. But they've carved out a specific niche, focusing on small and middle market financial services firms. It's a segment the really big Wall Street players sometimes overlook.
So an underserved market focus.
Exactly. And their edge, or what they hope is their edge, is this multi-product ecosystem. Think platforms like AllisFX, Surface Exchange for OTC foreign exchange, Rubicon OMS, Bond Quantum
So
Analytics.
like a full suite of tools.
Yeah, the idea is client stickiness.
Yeah.
You offer them a bunch of related tools, you make it easier to cross-sell, and theoretically harder for them to leave for a competitor.
That platform strategy sounds great on paper, definitely. But the financials, wow, they really show the cost of building that kind of tech moat, don't they?
They certainly do.
If we look at the trailing 12 months, the TTM figures as of early October, revenue is $14.83 million. Okay, that shows there's a real business there generating sales.
On traction, yes.
But then here's the number that jumps out. Net income TTM is a loss of $144.53 million, minus $144 million.
Yeah.
I mean, that is just a massive burn rate. How do we square that? How do you talk about operational cleanup and efficiency with a $144 million loss over the last year, especially for a company with a market cap of only, what, $14.3 million right now?
Look, that $144 million loss is staggering. There's no way around it. But
Okay.
it's also, well, it's kind of the classic high-stakes fintech gamble, isn't it? Management's line is that this huge loss comes directly from heavy but necessary investment, building out the platform, scaling the tech. It costs a fortune up front.
So the argument is this is an operational failure, it's R&D. It's investment for future growth.
Precisely. They're essentially betting the farm that these new platforms, Atlas FX, Bond Quantum, the rest, will hit hyperscalability and generate significant recurring revenue before the cash runs out.
A big bet.
A very big bet. Now, that recent hand-year financing suggests liquidity is okay for the moment, but the stakes, incredibly high. With only about 15.6 million shares out there and that tiny market cap, the upcoming Q3 earnings in November become absolutely critical. It's the moment of truth, really.
Right. Are the new products actually driving revenue fast enough to justify burning through that much capital? That's the question.
That's the billion-dollar or perhaps a $14 million market cap question.
Okay, this is where things get really interesting, potentially. The next few months look packed with possible triggers for the stock. But first, let's touch on confirmation. That Keyform 10K filing, their annual report basically, was due right around the end of September, wasn't it, for their fiscal year ending June 30th.
That's right.
And that filing is just crucial because it moves the story from, management press releases and
The
optimism.
formally audited SEC-verified numbers.
Exactly. The 10K is essential validation. Did that massive debt reduction actually happen as claimed? Is that Wilson Davis unit performance locked into the public record now?
So assuming the 10K confirmed the positive operational shifts, what's the next big thing?
Well, with that validation hopefully in the bag, the immediate focus shifts straight to the Q3 earnings release. That's estimated for mid-November, maybe around the 15th.
Right, and expectations there must be pretty high for year-over-year revenue growth, given everything we've discussed about new products and business lines like the stock loans. Expectations are definitely elevated. People will be watching that top-line growth number very closely.
What other scheduled events should you be watching for?
Well, beyond the company's own reporting, there are market flow events. The 13F filings coming out in October will show if any institutions started buying or selling shares in Q3. And then later, around mid-November, you often get ETF and index rebalancing events. For a small cap like Atlasclear, getting added to an index or ETF could suddenly create unusual buying pressure and visibility.
Forced buying, basically.
Sometimes, yeah, it can dramatically move a stock with a low float.
Okay, that covers the scheduled stuff. What about the more speculative side? The rumors, the market chatter, what's buzzing around Atlasclear?
Well, there's definitely chatter. Rumors are swirling about them potentially using that near capital to make a strategic acquisition, maybe another fintech or even a small clearinghouse.
Interesting. Using the cash offensively.
Right. And there's also been industry talk, particularly around their collaboration with Dawson James, that they might be exploring something in crypto, maybe custody or trading services. Still very speculative, though.
Crypto would be a whole new dimension.
It would. And then, don't forget the potential impact of that share buyback authorization, especially with so few shares outstanding. Plus, there's also some unconfirmed noise about maybe applying for a limited-purpose banking license that would really expand their capabilities in custody and settlement.
Wow, okay. A banking license?
Yeah, again, just talk at this stage. But all these rumors, M&A, crypto, banking license, they really highlight just how aggressive the reported strategy is for such a small, high-risk company. They seem to be trying to build that tech moat incredibly fast.
All right, so potential catalysts abound. But any opportunity like this, especially in small caps, comes with serious risk. Let's look at the chart, the volatility, and the technicals before we try to synthesize an outlook.
Good idea. The risk side is critical here.
So as of early October, the price is hovering around $0.05. But that 3-month volatility I mentioned earlier, the range was just, well, insane. 0.137210 up to $26.94. What causes that kind of wild swing?
That's classic low float, news-driven volatility. Extremely high risk, potentially high reward. A small number of shares changing hands on a piece of news or even a rumor can send the price flying in either direction.
Okay, so extreme caution needed there. But if you filter out that day-to-day noise, what are the technical signals actually suggesting right now?
Well, if you look at the indicators, they actually seem to be pointing towards accumulation lately.
Yeah.
The moving averages, for instance, are showing a midterm uptrend signal. The shorter-term average, the SMA 20, is above the longer-term SMA 60.
Okay, so momentum potentially building.
Potentially. Plus, the MCD indicator, which also measures momentum, is positive. That signals some underlying bullish strength. And maybe most importantly right now, indicators like the RSI and stochastic, They're both showing readings below 20.
Which means?
In plain English, it suggests the stock is potentially oversold on a short-term basis. It might be set up for a bounce, a reversal higher, probably fueled by anticipation of those November earnings we talked about.
So technically it looks kind of coiled for a move higher, perhaps?
The technical setup suggests that yes, but technicals only tell part of the story, especially here.
Right. That technical tailwind doesn't make the fundamental risks disappear. What are the absolute core concerns an investor must weigh against any potential upside?
Number one, without a doubt, is that substantial operating loss. That $144 million TTM loss. It might continue until, or unless, the new platforms reach full scale and profitability. That's the big overhang.
And that loss feeds right into the next big risk.
Exactly. Massive execution risk. Everything hinges on them successfully launching and integrating these new technologies, Atlas FX, Surface Exchange, etc., if those platforms stumble or don't gain traction fast enough.
The whole strategy falls apart.
Pretty much. And while their niche focus helps a bit, you can't ignore the competition. The fintech infrastructure space is getting more crowded, with bigger, more established players also competing hard.
So even with positive operational steps and maybe some technical tailwinds, that huge operational loss remains the biggest single risk factor specific to Atlasclear. Execution is absolutely everything.
Couldn't have said it better myself. Execution risk is paramount here. Hashtag tag outro.
Okay, so let's try to pull all this together. What does this mean for you, the listener, considering Atlasclear right now? We've got this validated operational cleanup, some strong technical momentum building, and these potentially high-impact catalysts lining up. What's the conclusion?
Well, synthesizing the sources, the overall rating comes out as decidedly bullish. Actually, quite strongly bullish, scoring an 8.2 out of 10.
8.2. That's high, given the risks we just discussed. What's the core rationale?
The rationale leans heavily on those fast-growing new revenue lines, like the stock loans we saw hitting 15% monthly revenue. Also, the strong strategic partnership with Henier, that $20 million tranche in board seats, isn't trivial. And finally, the multiple immediate catalysts, especially now that the 10K likely confirmed the recent progress, leading into that crucial Q3 earnings report in November.
Okay, so the sources see the potential reward outweighing the documented risks right now. How should someone think about investing? Short-term trade or long-term hold?
The analysis suggests two distinct paths, really. It looks highly attractive as a short-term catalyst-driven trade, specifically targeting the next quarter around the earnings release. Alternatively, it could suit a long-term investor, but only one who's patient and aiming to capture that secular growth in fintech platforms. And crucially, has a very high tolerance for risk and volatility.
Got it. High risk, potentially high reward, with near-term events driving things.
Exactly. If Atlasclear delivers in the November Q3 report, really confirming that aggressive growth trajectory, well, the groundwork laid by the debt cleanup and the Henier deal makes the case for a significant market re-rating look quite strong.
All right, let's leave our listeners with a final thought. Considering all that speculation, we talked about a potential strategic fintech acquisition, maybe even pursuing a limited-purpose banking license. How would achieving either of those incredibly ambitious goals fundamentally change the game? How would it shift the risk profile, the valuation, for a company that right now has a market cap of just $14.3 million? Does that level of ambition make the potential reward compelling enough to justify the very real risks we've outlined today? Or is it maybe just a distraction from the core challenge of making their current platforms profitable? Something to definitely mull over as we all wait for those upcoming financial reports.